because the messages will continue to come and I will really not be able to answer everyone. So let's try to be focused on the session. Okay, so a brief tutor's profile. You are already aware of me. A lot of people. My name is Hamza Abdul Haq. I teach paper FR and SBR. My contact number is shared. I have handed over my contact number to my personal assistant, and he will be answering the messages to you people other than the technical areas, which I will be answering myself. Thank you, JC. And I'm an ACCA member, experienced from Deloitte, which is one of the big four firms. Have been teaching since more than 12 years now. I've produced multiple nationwide positions, and even in the previous session, June and September, in both the attempts, we have got a worldwide position in SBR, and my students were the ones who scored the position even in June and in September. Plus, in September, we have also got a nationwide position from Qatar. So, Alhamdulillah, 3 positions in the last 2 attempts. So, the approach that I'm going to teach you for the SBR is one of the best approaches to the examination questions. So, I would want to quickly jump over to the main content of today's session. A quick recap of what the paper exactly is. There are 2 sections in the exam, section A and section B. 2 questions in section A, 2 questions in section B. The total marks is going to be 50 marks in section A and 25 marks each in question 3 and 4. That will also make a total of 50 marks. So that is in total 100 marks exam, and it is a compulsory one, and every single mark is to be attempted. Now in question 1, you're going to have the group financial statements, including the accounting standards as well. So consolidation plus standards will be there in question number 1. So we can say consolidation plus IFRS. In question 2, we are going to have the reporting and ethical implication. So this will be ethics plus the accounting standards. In question 3 and 4, in both of them, we are going to have again the accounting standards, plus the compulsory area is going to be the area of analysis. So these are the 4 areas which will always be there in all SBR exams. The first being the consolidation, the second being the accounting standards, third being the ethics, and fourth being the analysis. So these 4 areas will be there in every SBR exam. Plus, we can have the area of current issues and the area of framework, but this can be asked anywhere, either in question 1, 2, 3, or 4. This can be in either section A or this can be in section B. But few papers may have the area of current issues and the framework, and few papers may not have these areas. So in total, if we write down the areas which are examinable in the SBR, I will use the other screen for this. We can say the first area, which is a part of the course, is the consolidation. The second most important area is the accounting standards. The third area is the analysis. Fourth area is the ethics. These 4 areas are the compulsory one, which will be there in every ACC exam. And apart from this, the area of framework and the current issues may be there or might not be there. Now, normally what happens is, yes, Ajmal, we will be discussing the area of foreign subsidiary. Normally, we can say that the consolidation question will be there for approximately 15 marks in question 1. Analysis can be there for around 10 marks to 15 marks. Ethics will be there for around 10 marks. Framework can be there of around 6 to 8 marks. And the current issues can be there for 6 to 8 marks. And the remaining marks will be allocated to the accounting standards. So this is normally the breakup for the paper overall. Bibi Fatma is saying that she cannot hear me properly. I hope everyone else is hearing me properly. Jesse is saying hearing well. Mohammad Lamin is also saying hearing well. So maybe Bibi Fatma, there's some issue from your side. Sophie and Siri are also hearing very well. Hina is also hearing very well. That's great. Yes, Cindy is also hearing very well. So this was a quick overview of the areas which are examinable. Now, if we further divide the areas into a bit more detail, we say that in terms of consolidation, we have the area of step acquisition, which is one of the most important areas for the current attempt. We have the area of the cash flow statements. We have the area of the disposal and the area of foreign subsidiary. These are four most important areas of the consolidation, and these can be asked either with an income statement or with a balance sheet. But obviously the cash flow cannot be asked with an income statement or balance sheet. That is completely something else. But apart from that, the remaining three, step acquisition, disposal, and the foreign subsidiary, can be there with an income statement, which we can also say SOCI, and the balance sheet, the SOFP. So these are the content of the consolidation. Similarly, when we talk about the accounting standards, there is quite a lot of areas which are part of the accounting standards, starting from the most important ones: IAS 19, IFRS 2, IAS 32, and IFRS 9, known as the financial instruments, and IAS 12. These are the first priority standards. We can call this priority 1 accounting standards. Now, the priority 2 accounting standards are mainly IFRS 13, IFRS 15, IAS 16, IAS 24. These are all called the priority 2 standards. Apart from this, when we talk about priority 3 standards, we say that IAS 36, 37, 38, IFRS 5, IAS 21, IAS 28, and IFRS 11 are the priority 3 standards. And finally, after this, we have priority 4 standards, where we have IFRS 1, we have IFRS 8, we have IAS 34, we have IAS 41. All these are called priority 4 accounting standards. So we divide different standards into different priority levels so that people can identify which standards to focus more on, which to focus less on. So the importance level will actually decrease going downwards. So the most important are the priority 1, then priority 2, then 3, and then 4. Similarly, when we talk about the topic of analysis, in analysis we have financial performance analysis, we have non-financial performance analysis, and the last is that we have the integrated reporting. These are the 3 areas which are there in the area of the analysis. Apart from that, when we talk about the framework, there are 8 chapters, chapter 1, 2, 3, 4, 5, 6, 7, 8, which have different meanings, which have different rules, which have different logics, which are a part of the framework. And when we talk about the current issues, in current issues, we have exposure drafts, we have discussion paper, we have the practice statements, and we have the criticisms that we need to understand. These are the areas of the current issues. So this was a quick overview of all of the areas which are a part of the course, to give you a brief introduction about that. Okay, Sam wants a snapshot. So if I zoom this out, you can take the snapshot. So we can call this a syllabus overview. Okay, Jesse's thinking that 5 and 6 are rubbish issues. Jesse, basically everything which is a part of the course needs to be studied. T is saying what is T? This is basically the discussion paper. Discussion paper is a part of the current issues, and PS means the practice statements. We have two practice statements as part of the course, which is practice statement 1 and practice statement 2. Mohammed Lamin is saying something for the standards. Mohammed Lamin, I didn't get your question. Um, yes, Randolph, I will be sharing one note afterwards. Okay, basically priority 4 is not VUB. So if I go a bit more outwards, now you can take the complete picture. Inoka is saying, can you please confirm these 5 days webinars are available on Vimeo? Inoka, these will be available on the YouTube, not on the Vimeo. These will be available on the YouTube. Jesse is saying, what is criticism issue? An example, Jesse, criticism relating to IS 19 is a part of the course, that why, um, what are the problems in the current accounting treatment of IS 19. Zaira, these videos will be available immediately on the next day. Kwame is asking, sir, ED means the exposure draft. ED means the exposure draft. Okay, now how are we going to cover all these areas in the current webinar? Obviously, we cannot study the entire course in just 4 days webinar. So in day 1 and day 2, we will be revising the area of consolidation. And in day 3 and day 4, we will be focusing more on some difficult accounting standards. So these are the 2 areas that we are going to cover in this revision course. Yes, Hala, these will be available on the next day. Okay, so when we talk about the consolidation, we have already discussed there are multiple areas. Saurav is asking, sir, are we supposed to learn what specific IS standard is, or what will the question mention? Basically, Saurav, you need to understand what the standard actually um, uh, provides the accounting treatment. Whatever treatment is being provided by the standard is going to be applied in the scenario available in the question. So you need to know the rules, you need to know how to read the question, and you need to apply it onto the exam scenario. Okay, so now from current attempt, I personally believe that the important areas for the current attempt is going to be either the step acquisition or the cash flow statement. These are the two important areas which needs to be covered. So we are going to have different different questions being solved today. For step acquisition, we are going to solve the question of Robbie, which is even there in the BPP mock 2 as the question 1. So we will be solving that question of Robbie, which is one of the past paper questions of the SBR ones. It is there in BPP mock 2. For cash flow question, we are going to solve one of the questions by the name of Weston. This is one of the, again, P2 questions, because all of the SBR questions we have already done in the full course. So I would be solving some new questions so that the students who have attempted the full course have something new to study. The third area is the foreign subsidiary, and in the foreign subsidiary, we are going to solve a question by the name of Ribi. And as part of the fourth question, which is the disposal, we are going to solve the disposal plus the income statement, which is by the name of merchant. All these are past paper questions of P2, but we are going to solve them according to the rules of the SBR, because the logics are the same, the concepts are the same, but the way the question expects us to answer is what has actually changed. So these are 4 different questions that we will be covering in the first 2 days of the consolidation. So let's start from the first topic of the step acquisition. Now, when we talk about the step acquisition means acquiring a subsidiary in different steps. So let's suppose that we had a simple investment at 10%. We acquired 20% new shares to gain the significant influence, and now our holding is 30%. Plus, we acquired further 30% shares after a few years, and now our holding is 60%, which means that this company is now a subsidiary to us. And then we acquired further 20% shares, and our holding increased to 80%. So if we see, we have acquired these 30% shares in two pieces, 10% and 20%. So in two different pieces, in two different steps, we reached to our holding percentage of 30%. Then a further step up from 30 to 60 increased our holding to 60%. So these are all cases of the step acquisition. So we need to know the accounting when we purchased the additional 20% shares and we move from investment to associate. And then we should also know the accounting when we move from associate to the subsidiary. And then the third one, we also need to know the accounting that should be followed if we increase our holding percentage from 60% to 80%. These are three different cases where three different rules might be applied. So in case where we are acquiring the subsidiaries in multiple steps, in multiple pieces, that is what is called the step acquisition or the piecemeal acquisition as well. Kashif is asking which standards will be discussed. Kashif, we will discuss this in day 3, the standards that we'll be revising in the current session. Muhammad Ali wants a snapshot of the previous slide. Here you go, Muhammad Ali. You can quickly take the snapshot. Jesse is saying, what about joint control? Okay, Jesse, I'm going to discuss that as well. Sarah, we have no such plans till now. Let's see later on what we can do in this. Hala, same answer to you. Okay, so now when we talk about this step acquisition, the first case that we need to know is that let's suppose we had a 10% shares in a simple investment and we acquired an additional 20% shares to increase our holding percentage to 30%. So we need to know the accounting if we increase our investment to an associate. Similarly, maybe we didn't purchase 20% shares, rather we purchased 60% shares and we gained control of the company, moving to 70%. Or maybe we had an associate of 30% and then we acquired further 40% shares to increase that to 70%. Or maybe we already had 60% shares and we acquired 10% further to gain 70% shares. So these are 4 different cases where we need to know the accounting treatment. And the accounting for the first 3 cases are going to be similar, and the accounting for the 4th case will be different than the first 3 ones. Now, in the first 3 cases, the accounting is based on an assumption. Assumption that we take is that we do not say we acquired 20% shares. Rather, we say we first disposed of the 10% shares and then we reacquired 30% shares. Instead of saying that we acquired 20%, we say we disposed of the 10% shares and then we acquired 30% shares. So the assumption is that old investment is sold and repurchased at fair value. Old investment is sold and then it is repurchased at fair value. So because we are assuming that we have sold the old investment, obviously we also need to assume a price. So we assume that price to be the fair value. Now let's suppose, based on this assumption, we have a discussion. Let's say we acquired 10% shares at a cost of $10 million. And after 2 years, 3 years, 4 years, 5 years, some years later, we acquired additional 50-60% shares, and now we have gained the control of the company. So we acquired 60% shares, now we are having a holding of 70%. And the cost of this 60% shares was, let's say, $95 million. And on this date, let's assume we acquired 10% in 2010, and we have acquired further 60% in 2019. So the carrying amount of those 10% shares previously acquired, now their carrying amount has increased to $12 million. And their fair value on the date when we acquired additional 60% shares was, let's suppose, $15 million. Now, this is the case on which we are going to apply the rules of the step acquisition. Now, according to the assumption, we have sold the old investment at its fair value, which means we have sold for $15 million. So we would have received a cash of $15 million, bank debit by $15 million. And because the old investment is a simple 10% investment, it would be treated as a financial asset. Holding below 20% is treated as a financial asset. So we are going to credit the investment at its carrying amount of $12 million, which means $3 million being the balancing figure is the gain on the disposal. This is the gain as per the assumption that the old investment is sold. Now, according to the assumption, we have also repurchased the investment. So when we have repurchased the investment, we should be debiting the investment in subsidiary. We should be debiting the investment in subsidiary from the individual books point of view. But from consolidation point of view, the investment in subsidiary ultimately goes to the goodwill. So the investment in subsidiary or the goodwill should be debited by 15 million and the bank should be credited by 15 million. Because this is now the investment that we are making in the subsidiary because we have gained the control. Hina is saying selling and buying at fair value. Exactly, Hina, we are selling and buying back at the fair values. Josie is saying what will be the name in P&L for the gain. Josie, we can actually give any name. We can say gain on disposal of subsidiary. We can say gain on piecemeal acquisition. We can say gain on the assumed disposal. But that is not important. The classification is important. The name can be anything which can provide the correct understanding to the user. Abdullah is saying, what can I do to the original cost? Abdullah, basically, we are going to use the original cost in a while, but right now there's no use of the original cost still over here. Now, if we see, we had to make two adjustments for the assumption. And in this, if we see, we debited the bank by 15 million, we credited the bank by 15 million. So the net impact on the bank is 0. This means if we make an assumption as per the if we make the entry as per the assumption, we are going to say we should be debiting the investment in subsidiary or the goodwill by 50 million, and we should be simply crediting the financial asset by 12 million, and we should be taking the $3 million of the balancing figure to the P&L. So if we see what we actually did, we credited the financial asset, which means we de-recognized the old investment. We de-recognized the old investment and we recognized the new investment, which means the investment in the subsidiary. But we de-recognize the value at the carrying amount, but we recognize the new investment at the fair value. So the balancing figure that is going to the P&L is actually the difference between the fair value and the carrying amount of the old investment. So these are the theoretical wordings that we should be using in writing down the answer in the exam. So if I write a general statement for you people to understand, I can say that in case of step acquisition, the accounting is based on an assumption that the old investment is sold and repurchased at its fair value at the date further shares have been purchased. As per the assumption, the old investment should be de-recognized at its carrying amount, with the new investment, which in our case is the investment in subsidiary, should be increased by the fair value of the old investment. So normally when we are writing down the answer in the exam, our structure should be the general rule of the standard, and then we should be applying that rule onto the scenario. And then based on that, we should be drawing a conclusion. So let's suppose in my case, in the example that we are solving, we can draw the conclusion that whatever company name is, should calculate goodwill using, or we can say should use the cost of acquisition of the subsidiary as, now we can tell the value, $15 million for the old investment plus $95 million for the new investment, which will give us the value of $110 million. While calculating the goodwill, which is the sum of the fair value of the old investment and the cost of the new investment. Jesse is saying the assumption recorded in P&L is 3 million. It is non-cash item. Yes, exactly, Jesse, it is non-cash. but you're aware that we still record a lot of gains and losses which are non-cash in the P&L, but we still do. Ajmal is saying is not it the like substance over legal. Yes, Ajmal, we can say that. Legally, we have not sold anything, but in substance, we are saying it's equivalent to the investment being sold and then repurchased again. Bongani is saying they're mainly recorded at disposal gains and losses. Exactly, Bongani. Bibi Fatma is saying how many marks does it hold? Fatma, these can actually hold around 5 to 7 marks for the discussion and the application. Josie, we are coming towards that. Okay, now this is how we discussed the assumption and its application onto an example. But there's one more thing which we need to understand, which is Cindy is saying, so we use updated carrying amount when doing the disposal and the repurchase. Yes, Cindy, we use the carrying amount, whatever is recorded in the financials. We do not try to correct that. We simply take the carrying amount, which is there in the financials. Even if it's incorrect, we do not try to correct that. We just simply take that value. Hina is saying, sorry, can I take the picture of the writings? Yes, Hina, I will allow you to take the picture completely in a while. Saifullah is saying, Assalamu alaikum, sir. Wa alaikum assalam, Saifullah. Saifullah, you can see the agenda in the recorded lectures because we have already less time, so we will focus more on the study material. Cindy is saying thanks, but no entry for the difference between 10 and 12. Yes, Cindy, we are coming towards that. We are coming towards that entry because that will not be there every time. Sometimes it will have to be prepared and sometimes not. Saifullah, the lectures will be uploaded on the YouTube. Okay. Now we were discussing that the old investment of 10%, this is basically a financial asset which would have been treated as per IFRS 9. And as per IFRS 9, the financial assets are either classified at the fair value through P&L or the fair value through OCI. These are the two categories where we classify these financial assets. So let's suppose if the question says that we had classified them in the fair value through P&L. Law is asking, so does it mean we can't access this on the IBF Global anymore? No, Law, you can access them at the IBF Global as well. These will be uploaded on both the platforms, YouTube and the IBF Global. So all of the registered students have their access. They can study the full course as well as the revision course from a single site, while the students who are only obtaining the revision session can simply take the YouTube lectures. Jesse, you are wrong on this. Okay. So now we were discussing that let's assume that we had classified this as per IFRS 9 at fair value through P&L. This means the gain between 10 and 12 would have been recorded in the P&L. But if we say that we had recorded this in the fair value through OCI, not in the P&L, this means this gain between 10 to 12 would have been recorded in the OCI. But why do we record the gain or loss of fair value through OCI in the OCI? Why do we record the gain on fair value through OCI in OCI? The reason is that we call this an unrealized gain. And we keep it in the OCI until the asset is disposed of. Until the asset is disposed of. And on the disposal, how do we treat the previously recognized gain in OCI? What's the treatment of that? In this, we have two types of treatment. If it is an equity instrument kept in the OCI, we transfer that value to retained earnings within equity. So we can say we transfer within equity to retained earnings. But if it's a debt instrument, we transfer the gain or loss to the P&L. So the treatment for the equity and the debt instruments are different. There are total 12 hours, 3 hours for today and 3 hours for the remaining 3 days. So now, if we think of this case that we are studying, obviously we would have invested in the shares of a company. So this means ideally, on the disposal, we should have transferred that within equity to retained earnings. So if these instruments are classified in the OCI, this means this balance of OCI, the 2 million balance, should be transferred to the retained earnings. It should be a within equity transfer to the retained earnings because the gain has now been realized. So the second rule that we need to remember in the step acquisition is that any gain or loss previously recognized in equity shall be transferred within equity to retained earnings. But what we have written is any gain or loss, because there might be any gain or loss or there might not be, which has been recorded in equity should apply this rule. This actually also means that if we would have classified it in the fair value through P&L, if we would have classified it in the fair value through P&L, instead of OCI, the gain would have been taken to the P&L. In that case, the gain is already in the P&L. Therefore, we do not need to transfer it to somewhere else. That gain is already in the P&L. There's no need to transfer it. So the second rule only applies to the case where any value is recorded in the equity. If no value is recorded in the equity, then we do not need to apply this rule. Getting this, everyone? Okay, Wakar Fatma is saying, Assalamu alaikum, sir. Wa alaikum assalam. How do you know when they are allowable for reclassification and when they are not allowable for reclassification? Wakar, this is something which is mentioned in the accounting standard, like as per IFRS 9. It specifically mentions that in case of equity instrument, we do not transfer it to the P&L. Instead, we transfer within equity. But in case of debt instrument, we transfer it to the P&L. So this is what each standard will actually specify on its own. Ahmed Nabi saying, can the gain be recognized in the P&L? Which gain, Ahmed Nabi? In point 2, the answer is no. The gain will always be transferred to the retained earnings because it is going to be a case of an equity instrument. So that should always be going to the within equity amount. Okay, so yes, Mohammad Lamin, these will be uploaded tomorrow. So now the rules that we have discussed, the assumptions, they have the application. This is applicable for all of the first three cases, the first case, the second case, the third case. We assume we disposed of 10% shares and we reacquired 70%. We assume we disposed of 30% shares and then we have reacquired 70%. So the value that will be taken to the goodwill in all of these three cases, let me write on this side. In all of these three cases, when we are calculating working number 2 as the goodwill, we are going to keep the cost as the fair value of old investment plus the cost of new investment. This is going to be the cost in case of the first three cases. But when we talk about the fourth case, where we already had a control and we still have a control after the acquisition as well. So this case is called from control to control. We already had a control, we still have a control. So in wordings, we say control to control. In this case, the treatment is a bit different because we have paid cash for the 10% shares. So we are going to credit the bank by whatever cash that we have paid. But in this case, the NCI, which was previously 40%, has now reduced to 30%. So that's why we are going to debit the NCI, because the NCI has reduced from 40% to 30%. So the NCI should be reduced proportionately. And the balancing figure, which can be a debit, which can be a credit, is going to be taken directly to retained earnings. This should be taken directly to retained earning, which is the balancing figure. So ideally, we say the bank should be credited by the cash that we have paid. Balance taken to the retained earning directly is going to be the balancing figure. And the only impact that we need to think is the NCI. And this NCI has two methods to be followed. It can be calculated using two different methods. The first is that we calculate the value of the NCI from working number 3 and we divide it by the 40%. 40% was the original NCI, previous NCI. So if we divide the NCI by 40%, we are going to get the value of 100% of the NCI. And then we multiply it by 10% to get the value of the 10% of the NCI. So this is the way by which we can calculate the value of the NCI. Siri is saying, sir, if we got any unrealized gains and losses first, we have to mention in OCI during the year, at the year end, we transfer to OCE. After new realized value of it, then transfer to retained earnings. Exactly, Sri, that is the case. We take it from the OCI to the equity, which we can say OCE, and then we transfer it back to the retained earnings when it is disposed of. So the first method is to take the value of the NCI divided by the NCI percentage, which was 40% in my example, into the percentage that we have acquired. So we can say divided by the NCI percentage into the percentage acquired. So this is the way we are going to calculate the NCI. This is the only way that we are going to calculate the NCI. Harun is saying, what if the consideration was contingent on the profitability of the acquiree? Do we disclose it in the notes or record it as a financial liability? Harun, that is a part of the consideration that we will be discussing separately. Okay, so now that was the details of the step acquisition, in which the accounting that we need to learn is for the 4 cases where there are 2 different assumptions based on which we prepare the accounting treatment. Okay, now people who want the snapshot can take it. Here you go, everyone. You can take the snapshot and then you will have to zoom it separately later on to read it actually. Thank you, Emmanuel. Josie is saying, what about the second NCI method? Josie, that I mistakenly said 2 methods. It's one in case of step acquisition, 2 are there in case of the disposal. So we will be discussing the second one in the disposal case. Randolph is saying, so we should ideally ignore the screenshot and focus on the revision as this is slowing us down. And if I actually take the questions meanwhile, but you're right, we will try to focus more. Hafiz is saying, don't we calculate the NCI by multiplying the disposal percentage? Hafiz, this is the case of step acquisition. So there's no disposal right now. The rule that you are telling is in the case of disposal. Right now we are acquiring new shares. Yes, Jesse, these will be these notes will be uploaded on the OneDrive link. Emmanuel, I will try. Okay, so let's continue back. So now let me open one of the past papers question that we'll be solving in today's session relating to the step acquisition. Yes, Emmanuel, we'll be discussing the disposal as well today. Fasia is saying, sir, where can I access the notes? Fasia, I will tell you where you can access the notes. Mohammed is saying, in 4th case, what treatment of if NCI is carried at partial goodwill method? Mohammed, the treatment is the same in case of partial. In case of full, there's no difference in the treatment. The treatment is going to be the same. Okay, so now I'm sharing a new screen. In this, we have 9 pages if you see on the top. And there's one question by the name of Ribby. And we have 2 different questions as well. Apart from Ribby, we have a question of Robbie, which is of the step acquisition. Right now, we'll be solving. Ribby relates to the foreign subsidiary. The 3rd question is the merchant, which is the income statement and the disposal. And the 4th question is of the Western, which is the cash flow statement. So these are the 4 cases that we are going to cover in the consolidation. So let me go back to the question of the Robbie. Bibi Fatma is asking, what about the assumption in 4th case? Fatma, there is no assumption in the 4th case. The assumption is valid for the first 3 cases only. The assumption is valid for the first 3 cases only. That's why I have mentioned this curve with the assumption that these assumptions apply to the first 3 cases only. Okay, so let's get back to the question. Now I'm reading the question. It says that the following draft financial statements relate to Robbie, Hale and Zinc, all public limited companies as at 31st March 2012. Now we have property, plant, equipment, investment in hail, investment in zinc, financial asset, jointly controlled operation, current assets, and a lot of other values. If I go downwards to read it, it actually says that on 1st June 2010, Robbie acquired 80% of the equity interest of Hale. He acquired 80% of the shares. The purchase consideration comprised cash of $50 million. So we have paid the cash of $50 million to acquire 80% of the shares. And if we go and check our year end was May 2012. This means we have acquired these 80% shares 2 years ago. Now the question further says that Robbie had treated the investment in Hale at fair value through other comprehensive income. So we treated 80% shares at the fair value through OCI. Is this correct or not? Can we treat the shares in a subsidiary at fair value through OCI? Dilpreet is saying no. He's also saying no. This is yes. Basically, if I tell you in a bit more detail, we have a parent, we have a subsidiary, we have a group. Cindy is also saying yes. Now, parent prepares the individual financials or the group financials. Does the parent prepare the individual financials or the group financials? The answer is actually both. Yes, both. Parent will prepare the consolidated financials as well as the individual financials. Now, in the consolidated financials, the investment in subsidiary is taken to the goodwill at the cost. It should be taken to the goodwill at the original cost. But in the individual financial statements, we can measure the investment in subsidiary at either cost, or we can measure it at the fair value through P&L, or we can even measure it at the fair value through OCI. All three treatments are allowed, but only in the individual financials. So my question was, can a parent keep the investment in subsidiary at fair value through OCI? So the answer is yes for the individual financials and no for the consolidated financials. So the answer is yes for the individual financials and no for the consolidated financials. But if a company has kept the investment in subsidiary at fair value through P&L or fair value through OCI, we have to reverse the fair value changes in the consolidated financial statements to bring it back to the cost, and that cost is then used to calculate the goodwill. So from individual statements point of view, the investment can be kept at fair value through OCI, but from consolidated concept point of view, the investment cannot be kept at the fair value through OCI. So if we go back to the question, it says that we had a purchase consideration of $50 million. We have kept it in the fair value through OCI, so we're going to say that's correct as far as that relates to the individual financials. Now there's one more thing. If we see, if I go to the balance sheet, that the investment in Hale was kept at $55 million. although the consideration that we had actually paid was of $50 million. So this means from 50 to 55, $5 million is the change which would have been taken to the OCI. So we should ideally reverse that impact while preparing the financials. Getting this, everyone? Okay, people can't see the question, sorry. Now you people can see the question. So we were discussing that, let me tell you again, that the investment in Hale was shown, at $55 million, although the cost was $50 million. So this means that $5 million have been taken to the OCI. So we will have to reverse that. The second thing, the question is saying that a dividend received from Hale on 1st January 2012 of $2 million has similarly been credited to the OCI. A dividend received from Hale has been credited to the OCI. Now, what's the correct treatment of the dividend from subsidiary? So if we go back, and I'm saying, but that 55 is in Robbie's own balance sheet, not the group. Yes, exactly, because parents' individual balance sheet is the one that we are going to use for consolidation. So anything which is written in the individual financials will automatically go to the consolidated one. Getting this enough? Anything which is written in the individual finances of a parent will automatically go to the P&L, to the consolidated financials. That's why it is necessary to remove that in the consolidated financials. Ahmed Nabi is saying bank debit and the P&L credit. Yes, Hannah, that means that we need to eliminate that. Yes, before consolidation. So now, we were discussing about the dividend from a subsidiary. Now, when we talk about a dividend from a subsidiary, the dividend paid by the subsidiary, let's say subsidiary paid a dividend of $10 million. So the subsidiary would have made an entry as the bank credit by $10 million. Dividend paid retained earnings debit by $8 million, assuming 80% holding of the parent, and $2 million would have been taken to the NCI. This is the impact of the dividend in the group accounts. So when the subsidiary pays a dividend, the cash of the group gets reduced by $10 million, while the retained earnings will be reduced by parent's share of $8 million and NCI by $2 million. While the parent would have received the dividend of 80%, which means $8 million, so the parent would have made an entry as the bank debit by $8 million and the P&L credit by $8 million, because this is a dividend income for the parent. Now this P&L ultimately goes to the retained earning in the balance sheet. This ultimately goes to the retained earning in the balance sheet. So we can even write retained earnings in the bracket. So now when we consolidate both the financials, when we merge both the financials, the retained earning credit of 8, retained earning debit of 8 automatically gets cancelled out. Because one is the debit, one is the credit, both will be cancelled out. And the bank debit of 8, the bank credit of 10 will cancel the 8 and the net impact will be of 2. So this means in the consolidation, the impact of the intra-group dividend of 8 million has automatically been eliminated. The entry of both the values have automatically been eliminated. So out of this 10 million, 8 million was the intra-group given within the group, 2 million was given out of the group. So ideally, we should be eliminating the $8 million from the group financials. But even that 8 million has automatically been eliminated by crediting the P&L for the retained earning and debiting the retained earning. So this means we do not need to do anything to eliminate this. The values are automatically eliminated. Getting this, everyone? Jesse is saying it is dividend to interim and proposed dividend. Jesse, this is the treatment for all the types of dividend, whether it's proposed, whether it's paid, whether it's interim, whether it's final, all the treatments will be the same. Muhammad Ali, I will write the treatment of the fair value changes in a while in the Word document so you can check it over there. Okay. So now if we write down the treatment of these two areas, so before writing down, let's go back to the question. Now the question said that the dividend received of $2 million has been credited to the OCI. This means the entry that has been recorded in the question is not P&L. They have recorded the bank as debit and the OCI as credit. Although the treatment should have been retained earning. They have debited the bank. They have debited the bank and they have credited the OCI. Debited the bank, credited the OCI. Although the treatment should have been P&L or the retained earning instead of the OCI. So this means the correcting entry that we should be making is to debit the OCI and credit the retained earning or the P&L. By what amount? If I go back to the question, it says that we have received the dividend of how much? 2 million. So this entry should be made by $2 million in the answer. So OCI debit and the retained earning credit should be by $2 million. So if I write down the answer for this question by the name of Robbie, this is a simple case, it's not a step acquisition so far. So we can say that as per IAS 27, an entity can measure its investment in subsidiary at either cost or fair value through P&L, or fair value through OCI in its individual statements. But while preparing the consolidated financial statements, the entity should reverse fair value changes recorded. Now, this is the general rule that we have just written. Now, we are applying this onto the case that in case of Robbie, it had purchased 80% investment for $50 million, while the investment in the statement of financial position was being carried at $55 million, which means Robbie has recognized fair value change of $5 million in OCI, which needs to be reversed before consolidation. Robbie should recognize the following adjustment. What is the adjustment? It should be debit OCI by $5 million to reverse the gain, and credit the investment in subsidiary or the goodwill by $5 million. Further, any dividend paid by the subsidiary is paid to both parent and the NCI, while the portion paid to parent is an intra-group transaction and should be reversed in the consolidated financial statements. However, in case of statement of financial position, these are automatically eliminated. Now we are writing about the case. In case of Robbie, it has recorded the dividend received of $2 million in OCI instead of the P&L. Therefore, should transfer this $2 million from OCI to P&L, the retained earning, so that it gets eliminated automatically in the statement of financial position. So this is how the question was to be attempted in the exam. So in the exam, you are supposed to explain everything in the wordings. And we should ensure that the wordings are easy for the examiner to understand so that we can easily communicate the concept. Generally, we write 2 paragraphs, first being the general rule, second being the application, and then drawing a conclusion. The conclusion can be in the paragraph form, in a statement form, or in the double entry form. Now let's read the question further for the part 2. Because after this question, we'll take a break and then discuss the topic of the disposal after the break. And in next session, which on the Wednesday we'll be discussing the foreign subsidiary and the cash flow statements. Fatma wants a question again. Fatma, here's the question. You can take the snapshot quickly if you want. Esma, here's the question answer. Quickly take the snapshot. Now getting back to the question, we are reading part 2 now, which says on 1st June 2009, Robbie acquired 5% of the ordinary shares of Zinc. Robbie had treated this investment at fair value through profit and loss in the financial statements to 31st May 2011. Lord didn't get the snapshot. Here you go, Lord. Quickly take it. Done, Lord. Okay. Now the question says that on 1st December 2011, Robbie acquired further 55% of the ordinary shares of Zinc and gained control of the company. So this means it was a simple investment. Now we have 55% additional shares. So it's a subsidiary now. So it's from investment to subsidiary. The consideration for the acquisition was as follows. So we have 5% shares for $2 million. We acquired 55% shares for $16 million. And the question says that at 1st December 2011, which means when we gained control of the company, the fair value of the equity interest in Zinc held by Robbie before the business combination was $5 million, which means this is the fair value of the old investment of 5%. So if I go back to the OneNote, this is a case from investment to subsidiary where we had 5% shares, we acquired 55%, now we are at 60%. So we need the cost of 5%, we need the carrying amount of 5%, we need the fair value of 5%, and we need the cost of 55%. These are the 4 information values that we actually need. If I go back to the question to just check the values, the cost is 2 and 16, and the fair value is 5. So the cost is 2 and 16, with the fair value being the 5. So when we are calculating the goodwill in working number 2, we are going to keep the cost of acquisition as the fair value of the old investment plus the cost of new investment. So the cost used in calculating the goodwill should be $21 million. And this investment was being classified at fair value through P&L. So the difference between carrying amount and the cost would have already been recorded in the P&L. So we do not need to do anything. But we should be bringing the investment from the carrying amount to the fair value of 5 by making the entry as the investment in subsidiary debit by $5 million, the financial asset credit by its carrying amount, and the balancing figure taken to the P&L. So we need to calculate the carrying amount. Now, if I go back to the question, if I go upwards, we can see that the investment in zinc given in the balance sheet is of $19 million. This 19 million basically, this is the investment of what? Is this the old investment or the new investment or the total investment? We have made two investments in zinc. This 19 million, is this the new one, old one, or the total one? This is the total one. Yes, this is the total one, Dilpreet. So if I go back to the presentation, I'm going to say that if the total investment was 19 million, this has both the new and the old. Now, if the new investment was 16, this means automatically the old investment is the balancing figure of 3 million. So we have got the carrying amount of 3 million. So this means if we complete the entry, 3 million is the financial asset and 2 million is the P&L. Can we say that the gain on disposal of 2 million? Yes, exactly, Hina. We can say it to be the gain on disposal of 2 million. Ahmed Nabi is saying I did not get 3 million. Ahmed, let me explain to you again. The investment in the balance sheet was given at 19 million, which we are saying is the total investment, which means the new and the old. In fact, you can even understand this, that when we are saying that we should be debiting the investment in subsidiary, this should be included in the 19 million. But the question is not recorded at 5. The question is recorded at something else. So we are trying to identify at what value has the question recorded this amount. So according to us, it should be 21. But according to the question, it's 19. So we are saying that if the new investment is 16, then the old investment should be the balancing figure. Which is 19 million minus 16 million. So this is how we can simply calculate the value of the old investment. Getting the 7th of the Okay, great. So now, if we write down the answer of this question, so going on to the break, so this is again Robbie, but this time we are talking about the zinc. So we are going to say that in case of step acquisition, the accounting is based on an assumption that the old investment is sold and repurchased at fair value. In case of Robbie, it already had a holding of 5% in zinc, which was increased to 60% later, which means it is a case of step acquisition from no control to control. Therefore, based on the assumption, the old investment will be sold at its fair value of $5 million, and as it had a carrying amount of $3 million, would result in a gain on disposal of $2 million, which should be taken to P&L. While calculating goodwill, the cost of acquisition should be the fair value of the old investment plus the cost of new investment. Therefore, $21 million, which is $5 million plus $16 million, should be used as the cost of acquisition. So this is what the answer was supposed to be. Harun is saying, should we show the calculation first and then the narrative part, or should we narrate along with the calculation on the exam? Harun, it is always better to calculate the calculation first and then move towards the narration. Because once you are clear on what exactly to write, then it will be easier to write. Because if you're not clear, how would you able to draft your answer properly? So it is always better to first calculate and then draft. Cindy is saying, sir, could you summarize that of difference of 21 and other figure? Cindy, according to us, we should be recognizing the investment at 21. But the question had recorded at 19. So the difference is the gain on disposal of 2 million. So we are actually increasing from 19 to 21. So that will result in a gain of 2 million. So we can even calculate it that way. Getting this, Cindy? That according to us, it should be 16 plus 5. But according to the question, they have written 16 plus 13 plus the 3, sorry. So that's the difference actually. So that was the question relating to this. So now let's take a break, and then we are going to continue after the break in a while. So Siri is saying the carrying amount must transfer to P&L if they mention in OCI. Yes, Siri, not the carrying amount. The difference between the cost and the carrying amount should be transferred to equity if they would have mentioned OCI. Getting this, Siri? Not the carrying amount. The difference between the carrying amount and the cost should be transferred to equity if they would have mentioned the OCI. Clear, Siri? Okay. So let's take a break. Meanwhile, others can take the snapshot of the answer. And in 15 to 20 minutes, we are going to resume it back. Okay, everyone, welcome back and let's resume the session. So we had discussed the area of step acquisition before the break. And now we are going to discuss the next topic by the name of disposal. Disposal is going to be our next area of discussion. Now in disposal, we have 5 types of cases. That let's suppose we had a subsidiary at 70% and we completely disposed of that subsidiary. So in case of disposal, we had a subsidiary of let's say 70% and we completely disposed of that subsidiary. So now our investment is zero in that. This is the first possible case. The second possible case is that we had a subsidiary 70% and let's say we disposed of 60% of the shares and now we are holding only 10% of the shares. The third possibility is that we had 70% of the shares, we disposed of 40% of them. Now it's an associate of only 30%. Maybe we had an associate at 30% and we disposed of 20% of the shares and now it's a simple investment of let's say 10%. And the fifth case is that we had a subsidiary of 70%. We disposed of 10% shares and now it's still a subsidiary, but our holding percentage is now 60%. So this is the fourth case. These are the 4 cases which we should be aware of in the topic of the disposal. Now, in all of the first 4 cases, again, we have an assumption similar to the step acquisition, but an opposite one. In this, we are going to say that we don't say that we have disposed of 60% of the shares. We say we disposed of 70% and we reacquired 10%. We disposed of 70%, we reacquired 10%, or we disposed of 70%, we reacquired 30%, or we disposed of 30% and we reacquired 10%. So the remaining investment is the one that we have actually reacquired. So this is the assumption that we will be using in the accounting of the disposal. Now, let's start with the general concept of the disposal. If we talk about the general rule, when we dispose of an asset, we simply credit the asset, any asset, a general asset. We debit the bank and we record the balancing figure in the P&L as a gain or loss on disposal. So what is the objective? The objective is to de-recognize the asset, recognize the cash received, and balancing figure is the gain or loss on disposal. Now, in case where we are disposing of the subsidiary, instead of crediting the asset, we should de-recognize the subsidiary. Instead of de-recognizing the asset, we should ideally de-recognize the subsidiary. And to de-recognize the subsidiary, we should be de-recognizing its net assets, we should be de-recognizing its goodwill, and we should be de-recognizing the NCI. So if I make a proper entry over here for the first case, I'm going to say that we disposed of shares, we would have received cash in our bank account, and we should dispose of, de-recognize the subsidiary by de-recognizing its net assets, by de-recognizing its goodwill, by de-recognizing its NCI. By these three impacts, this will actually de-recognize the subsidiary. And then the balancing figure should be taken to the P&L. So this is how we record the entry for the disposal. We receive cash, we de-recognize the subsidiary, and we take the balancing figure to the P&L. This is the entry for the first case. Fatma, the assumption will be repeated in the second and the third one. Now let's suppose if I move on to the second case, where we disposed of 70% shares according to the assumption, and we reacquired 10%. The assumption is that we have sold entire 70% and we reacquired 10%. So the entry for the disposal of 70% is the same that we just made. The only difference in case 2 is going to be that we will be debiting our investment, our remaining investment at its fair value. So by the fair value of remaining investment, we are going to debit our investment, and all of the remaining entry will be the same. So the only difference in case 1 and case 2 is, in case 1, we make no impact of the remaining investment, but in case 2, we have to debit the remaining investment as well. Similarly, in case 3, the entry will again be the same. The only difference is that we're going to mention investment in associate in it. So we are de-recognizing the subsidiary, and instead we are recognizing our remaining investment. We are de-recognizing the subsidiary, and instead we are recognizing the remaining investment. Getting this, everyone? They're saying, sorry, could you repeat? The concept is simple. What we are trying to do is, we are crediting the subsidiary because we have disposed it off. We have received cash in the bank, and we are recognizing the remaining investment with the balancing figure taken to the P&L. This is the general concept. We de-recognize subsidiary because we have sold it off. We have lost the control. And then we recognize the remaining investment. What is left to us? And then we take the balancing figure to the P&L. Now, to de-recognize the subsidiary, we credit the net assets, we credit the goodwill, and we debit the NCI. Thank you, Manuel. So that's the basic concept, which is exactly a simple one. Yes, Cindy, we always de-recognize the whole subsidiary. Why? Because of the assumption. The assumption is we have sold entire 70%. We have again sold entire 70%. Even in the first case, we have sold entire 70%. So when the control is lost, we have to de-recognize entire 70%. But this rule will not apply on the last case. That is something different. That is something different. So yes, Cindy, exactly. As we have lost the control, we de-recognize the entire 70%. Hina is saying, what does the balancing figure goes to retained earning? Hina, when we say P&L, this will ultimately go to the retained earnings in the balance sheet. So the word P&L is from the SOCI perspective. The word retained earning is from the balance sheet perspective. One is from the income statement perspective and the other is from the balance sheet perspective. Getting this, Hina? Okay, great. So now we have discussed the accounting for the first three cases. Now let's move on to the fourth case. The entry for the fourth case would be different. Now in the fourth case, according to the assumption, we should de-recognize the associate. We should de-recognize the associate. Instead, we should recognize the investment. So the entry should be bank debit for the cash received against the disposal. The investment in associate is going to be credited. We de-recognize the investment. And instead, we recognize the simple investment, which can also be called a financial asset. So the simple entry for the last case is, for the fourth case is that we de-recognize the investment, we recognize the investment and the balancing figure taken to the P&L. Now, let's look at the values that should be recorded. When we talk about the values, let me use a new slide just to make it more easier to understand. We are debiting the bank. We are debiting the investment, which can also be known as the financial asset. Debit bank, debit financial asset, or the investment in associate. We debit the NCI, we credit the net assets, we credit the goodwill. So now this is the normal entry that we make. So the bank should be debited by the sale proceeds. The bank should be debited by the sale proceeds. The financial asset or the investment in associate should be debited by the fair value. The NCI will be calculated from the working tree. Net assets will probably be given by the question or else should be calculated from working one. And the goodwill should be calculated from working two. And finally, the P&L will be the balancing figure. So all of the values are simple to be calculated. However, the value of NCI can be sometimes critical because there are two methods to calculate the NCI. One is the partial goodwill method and the other is the full goodwill method. In partial goodwill method, we can simply say net assets at the disposal into the NCI percentage will simply give us the value of the NCI. The net assets at disposal multiplied by the NCI percentage will simply give us the value of the NCI. But in case of full goodwill method, we will have to calculate the NCI by the fair value of NCI plus their share of profit, which means net asset at disposal minus net assets at acquisition into the NCI percentage. Net assets at disposal minus the net assets at the acquisition into the holding percentage. This will give us the profit that belongs to the NCI. Apart from that, we even have to deduct their share of impairment from this to get the value of NCI. So this can be a bit critical, a bit difficult in the area of the disposal. Are you people getting this? Okay, good. Now getting back to the previous slide, in the fifth case, the last case, the entry is going to be different. In this also we have received disposal proceeds for the 10% shares. But this time the NCI, which was previously 30%, should now be 40%, which means the bank should be debited and the NCI should be credited, with the balancing figure taken directly to retained earnings, which we also say OCE. Directly to retained earnings means other components of equity. Now, the bank is going to be the disposal proceeds, the sale proceeds. The balancing figure is direct to retained earnings. That's not also difficult. The only challenging area is the NCI. Now in this, the NCI has two methods. One is similar to the piecemeal one, NCI divided by the NCI percentage into the percentage that we have disposed of. NCI divided by the NCI percentage into the percentage that we have disposed of. This is the one similar to the step acquisition. And the other method is net assets of the subsidiary plus the goodwill multiplied by the NCI percentage. So both the methods are correct, but we generally prefer this case where we had 100% holding in a subsidiary and we have not disposed of the controlling interest. So we had 100% holding, but we have not disposed of the controlling interest. So both the treatments are correct, both the calculations are correct. It depends whether it's a case of 100% or other than the 100%. Now, all the above entries that we had discussed actually relates to the group or the consolidated financial statement. We should also be aware of how to record the transaction in the individual financial statements, because the question can even ask us that. So in the individual financials, the entry is pretty simple. It's the bank debit and the investment in subsidiary credit with the balancing figure taken to the P&L. Again, the bank debit means the disposal proceeds, and the investment in subsidiary means the carrying amount, whatever it was, divided by the holding percentage, parents holding the subsidiary, into the percentage that we have disposed of. So this is how we can actually calculate the value of the derecognition. Ahmed is saying there are a lot of gain or disposal or acquisition, when to take gain or loss to P&L and when to OCI. Ahmed, the treatment is pretty simple on this. Whenever we are from control to control, either in case of disposal or in case of step acquisition, we take the gain or loss to the OCE. OCE means directly to retained earnings, and in all other cases we take it to the P&L. In all other cases we take it to the P&L. So whenever we have not lost the control or not gained the control, that will simply go to the OCE. Getting this, Ahmed Nabi? Okay, great. So now again, let's see one of the past papers question. Let's move towards that. So let's move towards a question by the name of Merchant. Here it is. Now in Merchant, it was actually a question of the income statement originally, where the adjustment 1 and 2 are the ones that we are going to discuss. And adjustment 3 is an easy one, so you can actually try it at your home. So adjustment 1 and 2 are the technical ones which we need to discuss in action. So the question says that on 1st May 2012, Merchant acquired 60% of the equity interest of Nathan, a public limited company. The purchase consideration comprised cash of $80 million. So we have paid $80 million to acquire the company. And the fair value of the identifiable net assets acquired was 110 million at that date. So we have paid 80. We have got the net assets of 110. The fair value of NCI and Nathan was 45 million. So the cost plus the NCI minus the net assets should give us the goodwill. How much? 15 million. Merchant wishes to use the full goodwill method. So that is what we have used to calculate 15. The share capital and retained earnings of Nathan were 25 and 65 respectively. and the other components of equity were 6 million at the date of acquisition. So if I go to the OneNote, to solve the question of merchant, the question has given us the information for the net assets, in which the question has given us the share capital, retained earnings, and the OCE, and has also given us the fair value. So the fair value was 110. Retained earnings and OCE were, retained earnings and share capital was 25 and 65. So 25, 65, and 6 were the OCE. So 6 is to be added over here. So this will take a total of 96, which means the remaining impact is the fair value adjustment of 14 million. So we have taken this 14 as the balancing figure. So 25 plus 65 plus 6 will give us the carrying amount. The fair value was 110, so the balancing figure is 14. Similarly, if we also calculate the goodwill, thank you, Josie. I'm sorry for the disturbance. My throat is quite badly affected, but the papers are more important right now. So when we are calculating the goodwill, it's the cost plus the fair value of NCI less the fair value of net assets. So the cost was 80, fair value of NCI 25, net assets 110. So we have a goodwill of 15. Now let's see further what the question has to say. It says that the excess of the fair value of the identifiable net assets at acquisition is due to non-depreciable land. So this means we should not be charging any depreciation on the fair value adjustment because it's non-depreciable land. Goodwill has been impairment tested annually and at 30th April 2013 had reduced in value by 20%. This means the goodwill was impaired by 20%. In which year? In 20x3. And if I go back to upwards, our year end in this question is 30th April 2014. So this is an impairment loss which relates to the previous year, not the current one. It further says, however, at 30th April 2014, which means by the current year, the impairment of goodwill had reversed. Is the reversal of goodwill allowed? Is the reversal of the goodwill impairment allowed? The answer is no. But still the question says, and the goodwill was valued at 2 million above its original value. So they have even recorded it above the original value. The upward change in the value has already been included in the above draft financial statements. So they have already recorded the upwards change. So we will have to reverse that. Prior to preparation of the group accounts. So if we go to the OneNote, we are going to say that the goodwill was impaired by 20%, which is going to be 15 into 20%, and the goodwill was 12, which they increased to 2 million above its original value. This means that they have increased the goodwill to 17 million. So 5 million of reversal needs to be reversed back. So 5 million of the reversal was not allowed, which the question has already recorded. So we will have to reverse that. So in terms of accounting entry, we can say we should be debiting the P&L and we should be crediting the goodwill by 5 million. Any confusion in this? So this was the first part of the question, which was an easy one. Noor Farah is saying, can you explain again? Farah, the question was that we actually had a goodwill of 15, which was impaired by 20%, so it was increased to 12. And the question has reversed that to 2 million above its original value, which means they have increased the goodwill by 5 million, which is wrong. So we need to reverse that. We need to reverse the 5 million of the gain. So we can say 5 million of gain needs to be reversed. So we are decreasing the goodwill by 5 so that it comes back to 12, and we are reversing the gain that they would have recorded by 5. Getting this, Farah? Okay, great. So getting back to the question, it says that merchant disposed of 8% equity interest in Nathan. So we originally had 60% shares and now we are disposing 8% of that. On 30th April 2014, which means the year end, for a cash consideration of $18 million, and had accounted for the gain or loss in other income. So we have actually disposed of the shares. We have disposed of the shares, 8% of them. So originally we had 80%. Was it 80%? No, 60%. So out of 60%, we disposed of 8%. So now our holding is 52%, which means we have not lost the control. So for this 80%, we received $18 million. And the question says that we have recorded the gain in the other income. So probably the question is talking about the individual financial statements, where the entry would be the bank debit, investment in subsidiary credit, and the other income credit. But from the group's point of view, the entry should be bank debit by 18 million and the NCI credit with the balancing figure taken to the OCE. Dulu is saying, since the gain in goodwill needs to be reversed, what happens if one ignores? Dulu, obviously you lose marks because the reversal is not allowed, and we need to mention this in the answer that the treatment of the question is wrong because that's a reversal which is not allowed. Okay, so now we have made two entries, one from the individual point of view, one from the group's point of view. Getting back to the question, Laura is asking to say that again. Laura, exactly what should I say again? or exactly what do you want me to repeat? The entries? Reverse. Lord, basically, if we would have ignored the reversal, then obviously we would have not got the marks. This is what Dulu was asking, that if someone ignores that, forgets that, what will happen? Obviously, you will lose marks. Okay. So now continuing, the question says that the carrying value of the net assets of Nathan at 30th April 2014 was 120 million before any adjustment on consolidation. So now the question is giving us the carrying amount being 120 million before any adjustment on consolidation. This means if I go back to the top, the question is giving us the carrying amount of 120 before any adjustment on consolidation. This means this is 120 before adding 14 into it. So the question is trying to tell us that the net assets at the date of disposal are 134. The value is 120 before any adjustment on consolidation. So this means the net assets at the date of disposal were in total 134. Getting this, everyone? Okay. So now getting back to the question again. It says that merchant accounts for the investments and subsidiaries under IFRS 9 and has made an election to show gains and losses in other comprehensive income. So merchant has recorded the gains in the OCI. The carrying value of the investment in Nathan was 90 million at April 2013 and 95 at 30th April 2014 before the disposal of the equity in trust. So this means that we have acquired the subsidiary 2 years ago at a cost of 80 million. And the carrying value is now 90 and 95. So this means a gain of 5 million in the current year would have been recognized in the OCI. So we should reverse this gain of 5 million from the OCI, because before preparing the consolidated financials, we should bring this back investment to the cost of 80. But because the question is about the income statement, we are going to say in the income statement there should be a reversal of 5. But if we were preparing a balance sheet, we would have said a reversal of 15. 5 for the current year and 10 for the last year. But according to the income statement, we are saying that a reversal of 5 million should be recorded. And the second thing is that we have got this 95 as the carrying amount. So we should be using this to check the gain on disposal that we were thinking. If I go down, this is the carrying amount which should be used. 95 is the carrying amount for 60%. So the carrying amount of 8% would be, if we use a calculator, it is going to be 95 divided by 60 into 8, which is going to be 12.6666. I'm taking it to one decimal place, which is 12.7. So the balancing figure of 5.3 is the gain recorded in the individual financial statements. This is the gain recorded in the individual financial statements. And this gain should be reversed in the consolidated financial statements, because the correct entry from the consolidation point of view is this one. So this is the correct entry for consolidation. So now to make this entry, we should first be calculating the NCI, because the formula of this is NCI divided by the NCI percentage into the percentage disposed of. So to calculate NCI, we should first prepare working tree. So if I go upwards to prepare the working tree, NCI, we should start the value of NCI from the fair value of NCI, which was 45. And we should be adding the share of profit of the NCI, which is from 110 to 134. The post-acquisition profits were 24, and NCI's share was 40%, so that would be 9.6 million. So this 9.6 million should be added in the value of the NCI. So 45 plus 9.6 will give us the value of the NCI at the date of disposal. But apart from that, we should also give them the share of impairment, which was $3 million. So 3 million into 40% is going to be 1.2. Remember, in full goodwill method, we give them the share of impairment as well. So this will be 45 plus 9.6 minus 1.2, which is going to be $53.4 million of the NCI. So this is how we have got the value of NCI to calculate the gain or loss underneath. So if I go back, we have this amount as 53.4 now. And the NCI percentage was 40%, and the percentage that we have disposed of is 8%. So if I use the calculator as 53.4 divided by 40 into 8, I will get a value of 10.68. I'm rounding it off to 10.7. So the balancing figure is again a gain of 7.3 million, which should be taken directly to retained earnings. So this is the value of the gain that should be taken to the retained earnings directly, which we call other components of equity as well. So this was how the question was to be solved. And now we are going to write down the answer in the word format. This is the question of merchant. So if I refer to the question again, what are the areas that we need to discuss? We first need to discuss about the impairment, that the reversal is not allowed. Then we have to discuss about the disposal. So we are going to say that as per IAS 36, there are certain reversals of impairment which are not allowed, which includes the reversal of impairment relating to goodwill. In case of merchant, the goodwill of its subsidiary, Nathan, had impaired by 20%, which was subsequently increased by $5 million during the current year. As the reversal is not allowed, the gain recognized in the reversal should be removed by making the following entry. Now, making the entry is not necessary, but if the question asks us, we should be aware of making the entry. So we are going to say P&L debit by $5 million and goodwill credit by $5 million. So this is how the entry was supposed to be made. Now for the next part, we are going to say that in case of disposal, where the control is not lost, the assumption of disposal does not apply. Rather, value of NCI is increased proportionately. Is there any difference between the cash received and the increase in NCI being directly recorded in the retained earnings? In case of merchant, in case of Nathan, merchant has valued the investment at fair value through OCI, which has increased during the year from $90 million to $95 million. It should be reversed. While preparing the consolidated financial statements. Further, the gain on disposal recorded in the individual financial statements, $5.3 million, should also be reversed. And instead, a gain of $7.3 million should be recorded directly in retained earnings. So this is the final answer which was supposed to be written in this question. You people can quickly take the snapshot of this. And I saying if we get the calculation wrong but state the rules correctly, how many marks do we get? And if the calculation is wrong but you have written the theory correctly, you can get maximum marks, obviously. But the calculation is also important. So up to 20 marks are there in the exam, in the entire exam for the calculation. So that depends on how important was the calculation in that question. Like in this question, the calculation was a material one. So without performing the calculation correctly, you would have gained less than 50% of the marks. So we should be aware of both the calculation as well as the theory. So we have completed today's target. We revised the step acquisition. We solved one question of that. We revised the disposal. We solved one question of that. And we even discussed some part of the income statement as a part of this question. So out of 4 areas of consolidation, we have revised 2 of them, and the remaining 2 will be covered in the next session. Okay, Huawei, thank you so much. I'm glad that my lectures are understandable to you people, because SBR is one of the difficult areas, and it's very important to make people understand that easily. Sri saying, what about tomorrow's class? Sri, we do not have a class tomorrow. We have the class on Wednesday. So it's Monday, Wednesday, Friday, and Saturday. These are the 4 classes which have been scheduled. So next we are meeting day after tomorrow. Meanwhile, you people can revise the step acquisition and the disposal on tomorrow's day. And we will be continuing with the cash flow and the foreign subsidiary on the Wednesday. For Friday and Saturday, we will be having the area of accounting standards. So thank you so much, everyone. Thank you for today's session, and looking forward to meet you all on Wednesday. Till then, take care and Allah Hafiz.